Welcome to this video on fair lending. In this video, we'll cover marketing discrimination. Referencing the interagency fair lending examination procedures that FDIC consumer compliance examiners use, we'll take you through the marketing discrimination risk indicators. We'll also offer some practical tips to consider when addressing marketing discrimination in your bank's compliance management system, or CMS.
Marketing impacts any area of advertising, including mediums such as print, radio, direct mail, call programs, TV, billboards, online ads, and social media and streaming video. Basically, fair lending risk can potentially exist in any avenue that banks use to reach prospective applicants. Marketing decisions are affirmative acts to include or exclude areas or certain individuals from a bank's marketing strategy. Disparities in marketing between two areas may reveal that the institution prefers one to the other. A difference in marketing to racially different areas could reflect discrimination risk. Discrimination risk can also include advertising methods that discourage individuals in prohibited basis groups from applying for loans, or advertising only in media that serve non-minority areas within the bank's market area. Banks should consider whether the content of marketing, such as images, could discourage applicants on a prohibited basis. But what is a prohibited basis?
The prohibited bases are described in the two primary laws covering fair lending, the Equal Credit Opportunity Act, or ECOA, and the Fair Housing Act, or FHA. Both of these laws prohibit discrimination based on race or color, religion, national origin, and sex. ECOA also prohibits discrimination based on marital status, age, an applicant's receipt of income from a public assistance program, and an applicant's good faith exercise of any rights under the Consumer Credit Protection Act. Under ECOA, public assistance means any federal, state, or local governmental assistance program that provides an income supplement that is continuing and periodic. The FHA prohibits discrimination based on familial status and disability, which is referred to in the statute as handicap. It also prohibits retaliation against a person who exercises his or her rights under the FHA, or retaliation against a person who helps another person exercise his or her rights under the FHA.
ECOA does not generally extend to a creditor's pre-application marketing practices, such as the selection of consumers solicited for a credit card. In this context, the regulation applies only after consumers respond to a creditor's offer of credit. That said, ECOA does prohibit a creditor from making any oral or written statements to discourage people from applying for a credit on a prohibited basis. This prohibition covers advertising among other forms of communication. For example, credit advertisements cannot use words, symbols, models, or other forms of communication that express, imply, or suggest a discriminatory preference or a policy of exclusion on a prohibited basis. Remember that ECOA applies to both consumer and commercial credit. With respect to residential real estate transactions, the FHA prohibits statements or advertising with respect to the sale or rental of a dwelling that indicates any preference, limitation, or discrimination on a prohibited basis. In addition to this general prohibition, the FHA prohibits several specific advertising practices.
Now let's discuss 7 types of marketing discrimination risk as outlined in the interagency fair lending examination procedures, which are listed as M1 through M7, where the M stands for marketing. These indicators represent areas that may warrant further review to mitigate fair lending risk. Let's begin with M1, which is advertising patterns or practices that a reasonable person would believe indicate prohibited basis customers are less desirable. For example, If a social media marketing campaign emphasized that borrowers who are between 20 and 30 years old are a bank's best customers, this could indicate that the marketing campaign potentially discriminates on the basis of age.
The next risk indicator, M2, is advertising only in media serving non-minority areas of the market. For example, if a bank posted advertisements on commuter rail billboards at stops in non-minority residential areas, but not at stops in minority residential areas, there could be fair lending risk.
M3, the third risk indicator, is marketing through brokers or other agents that the institution knows or has reason to know would serve only one racial or ethnic group in the market. With that said, a creditor is allowed to affirmatively solicit or encourage members of a traditionally disadvantaged group to apply for credit, especially groups that normally might not seek credit from that creditor. It's important to remember to assess any marketing activities conducted through brokers or other agents when considering potential marketing risks.
M4 addresses the use of marketing programs or procedures for residential loan products that exclude one or more regions or geographies within the institution's assessment or marketing area that have significantly higher percentages of minority group residents than does the remainder of the assessment or marketing area. For example, a bank might market home loans through direct mail to residents in select zip codes. Such a strategy could present risk if the zip codes that are excluded from such a campaign have higher percentages of minority group residents. By targeting certain areas, the institution could be excluding areas where prohibited basis group residents live.
The next risk indicator, M5, relates to using mailing or other distribution lists or other marketing techniques for pre-screened or other offerings of residential loan products that explicitly exclude groups of prospective borrowers on a prohibited basis, or exclude geographies such as census tracts, zip codes, etc., within the institution's marketing area that have significantly higher percentages of minority group residents than does the remainder of the marketing area. The question here is whether marketing materials that the bank uses specifically target or exclude geographies or persons on a prohibited basis. M6 addresses when the proportion of prohibited basis applicants is significantly lower than that group's representation in the total population of the market area. For example, if the percentage of applications from Hispanic applicants was lower than that group's representation in the total population in the bank's market area, it could be that the bank's marketing efforts are not attracting applicants from that population. Efforts to understand the cause for any differences in the proportion of applications from certain groups could help identify whether marketing efforts are reaching that group.
The final risk indicator is consumer complaints alleging discrimination in advertising or marketing loans. Complaints about advertising can provide helpful insight into fair lending risks associated with a bank's practices. Complaints might raise concerns about advertisements that include images or the depiction of people that imply that certain demographic groups are disfavored on a prohibited basis. While we've gone through the marketing risk indicators in several examples, we want to note that specific findings of illegal credit discrimination in marketing would depend on the facts and circumstances of the situation.
Let's talk about how a bank's compliance management system, or CMS, could help address fair lending risk. Policies and procedures provide bank staff involved in the marketing process with guidelines as to how marketing decisions should be made. One way to mitigate fair lending risk is to review marketing policies and procedures to determine whether the content of advertisements, radio or call scripts, and other communications would discourage someone on a prohibited basis from applying for credit. Ongoing training about the marketing-related requirements of ECOA and the FHA with practical examples can help bank personnel understand how to communicate fairly to prospective applicants and not to suggest some demographic groups are favored over others. Another helpful practice for strengthening consumer compliance efforts is to communicate clearly to lending staff that your bank seeks to serve all geographical areas and persons in its market area, and that discouraging prospective applicants on a prohibited basis will not be tolerated, whether through oral or written communications. Monitoring and/or audits can play an especially important role when it comes to considering whether an existing, new, or revised marketing approach complies with applicable fair lending laws. Marketing budgets may be limited, and bank personnel have to decide how to spend marketing dollars most effectively. Considering the fair lending implications of marketing decisions can help banks mitigate the risks of illegal discrimination. An effective CMS also includes processes to identify consumer complaints involving marketing issues. Reviewing and investigating complaints that allege discrimination provide bank personnel and management with helpful insight into ways in which marketing discourages certain prospective applicants on a prohibited basis.
As we conclude, we'd like to remind you that the FDIC has technical assistance, videos on a number of other topics, including other videos on fair lending that can be found on the Banker Resource Center at www.fdic.gov. There are many resources available on the FDIC website, including the Consumer Compliance Examination Manual and the Interagency Fair Lending Examination Procedures. If you need additional information or have questions or comments, please contact your bank's Consumer Compliance Review Examiner or email the FDIC at supervision@fdic.gov. Thank you for viewing this video. We hope you found it both useful and informative.